Marcus Warren is here of Warren Wealth Management, and as the end of the year approaches, you may be looking at your finances. Maybe you're thinking about retirement. So today is one of our features, which is Ask Marcus, where he answers your questions with all of his expertise. Marcus, welcome in. Happy holidays to you.
Yeah, thank you.
Are you getting the holiday feel yet? You feeling Christmas?
Yeah, it's beginning to look a lot like Christmas around the Warren household, but yeah.
Are we going to start singing together? Are we going to start singing? It's beginning to look a lot like Christmas. We're naturals.
Hey, look at that. Harmony.
I love it. Okay, I do love when you come on the show because you could easily talk over my head, but you're very nice in saying, okay, I'm going to make you, able to understand this. And if you have any financial questions, Marcus, if someone wants to, for the next time we do an Ask Marcus segment, how do they get their question involved here?
Yeah, well, they can go to warrenwealth.net. You go there. At the top of the page, there's a button that says Ask Marcus. You can type in your question, and it might be answered on the show. If not, we might answer it on the radio show.
There we go. Okay, so here we go. Let's get started here. Here's your first question. It says, heard someone say that a good time to do a Roth conversion is when the market is down. Why is that? What does that mean? And that's from Jerry in Crestwood. Okay, Jerry, good question. Marcus, have at it.
Yeah, so a Roth conversion. So the basis of a Roth conversion is to move money from, like an IRA, a tax-deferred account, over to a tax-free or a Roth account. And so he's asking, hey, the market's down. Is it a good time? Why am I hearing that it's even a better time to do a Roth conversion? Because generally you do Roth conversions because you're paying taxes now, hopefully at a lower rate, with the assumption that taxes are going to be higher in the future. Now, when the market is down, it creates another opportunity because the investments in stocks or mutual funds that you move over to the Roth, they're down right now. And so generally speaking, the market does tend to rebound. And now if you've done a conversion and they're in the Roth, now when they start to grow, it's all tax-free. So, now could be a good potential time to do a Roth conversion. One, just for the tax benefits, but two, because the market is down and you can get some tax-free growth.
All right. So right now the timing for that question was perfect.
Yeah.
All right. Here's the next one. This says, I have a traditional IRA with stock in it that I have not needed to use for income because I receive Social Security and a pension. I turned 72 this year, and I learned about RMDs. I would hate to take money out of the IRA because the stock is at a loss for the year. Any way to avoid this RMD? And I guess, first of all, that acronym, tell us what that means.
That is a required minimum distribution. So when you're 72, like this gentleman is, you have to pull your money out of your IRA, 401k, those tax-deferred accounts. And so his question, what was his question? That he would...
that he's wondering, he said he hasn't needed, he's had a traditional IRA, because he's getting Social Security and a pension. So
yeah, he doesn't need it, and he still has to take it. The market's down, and he doesn't want to take money out of a depleted asset. And unfortunately, sorry, Bill, you have to take it out. Required minimum distributions are basically, it's the IRS's way of getting a guaranteed stream of income from retirees. So basically they're saying, hey, you've had your money in this tax deferral so long. We've given you tax deferred, the opportunity for tax deferred investments for so long. Now it's time for us to get our cut. We want our cut. You cannot put it off. If you do put it off, by the way, the IRS is so serious. If you decide not to take your RMD, so if Bill decides to be a rebel and live on the wild side and says, I'm not going to take it, the IRS will penalize him 50% of what he was supposed to take out. So say he was supposed to take out $10,000 and he does not do it, the IRS will penalize him $5,000, 50%. They're serious about getting their money.
Ooh.
Bill, go ahead, take your RMD.
All righty. Well, it's nice to be in that situation, though, where you don't need it. So congratulations, Bill, on your financial success. But with that being said, you got to pay Uncle Sam.
Absolutely.
All right. So here's the next question. I read an article that said actively managed mutual funds do not consistently beat the stock market. What does this mean? Should I fire my financial advisor? Okay, Marcus, have some fun with this one.
Yeah, so, it's like this. Actively managed mutual funds, that's basically when you have a money manager, trying to buy and sell investments within it. And historically, actively managed mutual funds or, advisors who are actively managing your investments, they generally don't beat the market or just passively managed funds. As a matter of fact, it's rather pathetic, if I do say so myself, where maybe over the short term, so maybe 1 year or 2 years, your genius financial advisor with his algorithm or his trading platform, that's hogwash, by the way, they may be able to beat the market at 1 or 2 years. But historically speaking, actively managed mutual funds, advisors who actively manage their clients' investments, after 5 years, 85% of them underperform just what the general market would have done. After 10 years, 90%, and after 20 years, 95% underperform by just having your money in a low-cost exchange-traded fund or the index. So the question was, so should I fire my financial advisor? And generally speaking, financial advisors, they used to hang their hat on investment management, saying, I can get you better returns. And if that is why you went with that advisor, maybe you should fire them. But the value from an advisor shouldn't come from investment management. There's too many tools and things out there now that the do-it-yourselfer can use. Investment management, you can't hang your hat on that. The value that I feel that I provide within our practice is not investment management. That's easy. It is income planning. Preparing you to take Social Security. How do you want to take it? Preparing you to take Medicare. We're talking about tax planning, estate planning. Those are the things that my clients basically pay me for. The investment management, you know what we're going to do? We're going to put you in a good basket of low-cost exchange-traded funds based on the index. We're going to monitor that a little bit. I don't have an algorithm. I'm not, I don't have 18 screens and I'm clicking and clicking. Nope. You get your most value from all of that other stuff: taxes, income, Social Security. That's where the value is.
Oh, all right. That makes perfect sense to me. I like the income planning side of it, and I also like the fact the education side of it.
Absolutely.
That I'm telling you exactly why, and so that I understand the decisions that are being made.
There you go.
Love that. Okay. Finally, here's our last one. What am I missing about tax loss harvesting? I've seen so many people talk about taking advantage of the markets being down to harvest some losses. How does it work, and is it something I should do before the end of the year? This is Stephanie from Clarksville.
All right, Stephanie, so tax loss harvesting is basically when you take the capital gains that you have in your account and you try to offset them against the capital losses or your losers in your portfolio. And, does it make sense? Yes, it does make sense if you're trying to lower your tax bill, because if you do have some gains that you want to pull off the table and you may have to pay a pretty hefty tax, you can find some of those investments that haven't done as well and offset some of those gains and minimize your tax bill. So that can be a good strategy for you.
All right, let's try to squeeze one in real quickly. It says, I was planning to retire next year at age 63. I don't want to start Social Security benefits yet, because if I wait until 67, I'll get almost $800 more each month. Will it be okay if I drain my IRA until 67, or should I work a little longer? This is a well thought out, good question from Dan in Louisville.
Yeah, and really it depends, Dan. Of course, you can take it as early as 62. You want to take it at 63. You just have to understand you're going to get 70 cents on the dollar, basically, of what you would have received at 67 or full retirement age. I don't think it's a good idea to drain your IRA just to keep Social Security afloat, but it really depends on his particular circumstance. So I would say sit down with a good fiduciary advisor. You can go to our site, set up a time. We can look into it, but I'm not sure. I hate the word drain my IRA. That sounds like you're going to deplete it all the way to zero. Might not be a good idea.
You know what I love about these questions, Marcus, real quickly, is that it shows that everyone's individual situation is just that. It's individual, it's personalized, and that's what you do. Look at your situation and do what's best for you. It's not a cookie cutter thing.
Not cookie cutter. There's no one size fits all. It really does depend on your personal circumstances.
All righty. And if folks have questions, again, go to the website there. Also, you can set up a conversation with Marcus, 15-minute conversation. See if the fit is good for you. Marcus, they can just go on your calendar via your website, right?
Yep, go to the calendar, pick out a date. We'll have a 15-minute phone call, find out if we're a good fit. If we are, we'll get you into the office and hopefully get you on the right track.
Marcus Warren, thank you for the information.
Appreciate it. Thank
He's
you.
an educational expert, man. I'm going back to school with Marcus Warren of Warren Wealth Management. Okay, here come the holidays, and you probably have a lot of holiday parties to attend. Would you like to have a nice big smile and be proud to be in that picture? You can do that with Freedom Mini Dental Implants. Wait till you see some of the before and after pictures coming up next.